Good afternoon, everybody. It's Tuesday, and you know what that means. It's close of business Tuesday. We've got a really great show for you today. I'm starting to feel like Jack Benny. We've got a really big show, but we really do. Today is Tech Tuesday, and we're going to talk about tech transformation across the energy landscape. We're really excited to have Mike Bingston and Michael Terosian from Baker Botts joining us. Mike runs the firm, and Michael is the, I don't know if, can I say you're the head of the Silicon Valley office, Michael? He's the co-lead of the emerging company VC practice. And so we're super excited to have you guys. And we've also got a really big star with us, Scott Gale. Scott is the executive director of Halliburton Labs. It's a new venture for Halliburton. And so we're super excited to have these three guys. We also have our own Deanna Zhang, who's a director in TPH's Energy Tech Group. So get your tech juices flowing while we do a little bit of pregame to tell us all what's happening in the world. Mike Bradley, do you have any good oil news for us?
I wish I did, but it looks like this is a continuation of what we've seen for the last couple of weeks.
Okay, moving right along. We're going to Matt Portillo. I'm joking with you, Mike. Give us what's going on in the oil markets. We've heard a lot about Libya, the dollar. We know we're kind of in a sideways period right now.
Yeah, what we've seen over the last, 5, 6, 7, 8 weeks, when the dollar was weak, crude oil was doing well, and now when the dollar is getting strong, it's not, which is kind of counterintuitive. Anyways, but I think the biggest issue right now is that really. Supply and demand are really coming into focus here. I mean, from a supply standpoint, we're seeing Libya is looking like it's about to ramp up. The question is how much. At the beginning of last year, this year they were around 1.2 million barrels a day. They're down below 100,000. Some think that they can get up to 250, 300,000 barrels a day here in the next several weeks. We shall see. And some think that they can get as high as 500,000 by the end of the year. We shall see on that as well.
What are the constraints in Libya, Mike? Is it money? Is it physical constraints? Like what's getting in the way if they really went for it?
Money is a big deal, but I think security is the bigger issue. Is just keeping these ports open and obviously having the word of the general to allow these barrels to flow. I mean, they do have oil that's sitting there on the dock, so they can really start loading pretty quickly. And so it shouldn't be a big deal to start loading a couple 100,000 barrels a day. It's just, right now, it is a security issue more than anything, and whether some sort of a ceasefire will hold over the next couple of weeks.
And what about natural gas?
Natural gas has really gotten smoked here in the last week and a half, 2 weeks. Last week you had a really big build in inventories, and that put a lot of pressure. But what we're seeing is very interesting right now is that the difference between the prompt price and say the 12 or 24-month strip is about as wide as it ever has been, versus a 24-month strip, we're about 95 cents. We haven't seen that in the last 5 or 6 years. On the other hand, we're seeing a net spec length in natural gas futures is very, very high at this point in time. So it's really a quandary of what's going on. But longer term, it looks like, short-term price is probably going to have to is going to have to close a long-term price. It may be a little bit dicey here over the next couple of weeks, maybe months, but as we see it into next year, we think that the long end's probably going to stay where it's at, and the short end's going to start coming back up.
So Matt, as you take that, I know you've got some EV and some other tech type things to hit on, but before we do that, take that oil and gas market and tell us what the chatter is in oil and gas related stocks today.
I think on the gas side, we've actually continued to see pretty constructive commentary from investors that we've been talking to. They're very aligned with us on our 2021 bullish call for natural gas, which we still think is going to range between 275 and 3. And more importantly, this was kind of the final leg down of concern that we had in the gas market. We were a little worried coming into October with where storage levels were that we would see some pressure on the front end of the curve. And I think now that we've gotten that behind us, we're moving more into kind of a green flag situation here where you can essentially go out and purchase high quality gas stocks at a pretty big discount to intrinsic value over the longer term. More importantly, investor conversations are really turning to 2022. The forward curve still does not reflect the fact that the industry is going to hold the line on supply growth and that we have, as we march out over the next few years, another wave of LNG demand. And as that back end of the curve continues to improve, I think you're going to see sentiment towards the gas equities improve as well. So gas equities in general have actually done pretty well, given that the rest of the space is sold off. But we are seeing quite a bit of bullish sentiment from clients we're talking to and adding to incremental exposure here at this point.
And Matt, when people call you and say, I'm really bullish on gas, you don't have to name names, but sectors, do they go for the upstream names? Do they go for the midstream levered gas names, or what else? Or utilities? How are people playing gas?
Yeah, I think you've generally seen it reflected in two forms. First, on the upstream side, in the companies with a little bit more market cap and a little bit lower leverage. Typically investors are still looking for companies below 1.5 times on the leverage profile side. So the list of names we're seeing both in the U.S. and Canada is pretty short, but those are generally high quality stocks that we are seeing investors add positioning to today. And then we've actually seen a pretty significant amount of capital come into some of the gas levered midstream equities. Just thematically, you have less volumetric risk going forward. So we've seen it expressed in two different ways in the industry right now.
Well, I know you've got EVs and hydrogen burning holes in your pocket, so let me get you talking on those two flavors.
Yeah, sure. So client conversations have really accelerated over the last week around the impacts of the automotive industry. And I think that was kind of spurred on the back of BP's commentary around peak oil demand. And it's really trying to break down the reality of the near-term impacts of electrification of the auto fleet and the longer-term impacts. And I think what we've generally been looking at, and we've been spending a lot of time in various different markets from a global perspective, breaking down not only the policy around EVs, but also really the ability for these countries to execute their plans. And I think you're seeing a pretty wide bifurcation on a global perspective. So I just wanted to hit on 2 or 3 markets that I think are interesting to watch. Norway, I would say, is the most progressive market when it comes to a shift away from ICE vehicles. So as we've highlighted in the note, Norway plans to phase out petrol cars by 2025. If you look at current sales in country, around 50 to 55% of all vehicles sold are electric. And when you include hybrid vehicles, that number actually climbs to about 80%. But what's important about that statistic is how much EVs have actually penetrated the existing auto fleet. So as of this last year, electric vehicles are about 260,000 vehicles on the road. And that compares to a total market that has about 2.8 million vehicles on the road. So even though you're seeing these really eye-popping sales in country on a new sales perspective, the actual impact to the auto fleet as it stands today is pretty de minimis, and it's going to take about a decade for that fleet to turn over. So I think that's one market just to watch in terms of the leading edge of progression around the impacts to EVs. The second market I wanted to highlight is China. China has been very progressive on electrification. They started a policy in 2009. It's been very heavily subsidized, and they're doing it for a couple of different reasons. They're trying to reduce pollution. They're actually trying to gain a technological edge and build a fairly sizable auto industry around the EV fleets. And that has been pushed through in a number of different ways from a policy standpoint. But if you look at China's targets for 2020, they're hoping to reach 5 million vehicles on the road that are electrified. As of August, they're at about 4.6. And by 2025, they hope to hit about 25% of their sales as being electric. That matters, but in a big picture and context of oil demand, those 4.6 million vehicles that are electrified on the road today compared to a total vehicle in use fleet of about 230 million vehicles. So again, big picture, pretty big aspirations. I think the reality of the world is it's going to take a very long time for the fleet to turn over. Last point on this, India. We hit this in the last few weeks. India has some pretty aspirational goals to electrify. They plan to have 30% of their autos electrified by 2030. The big problem here is that they don't really have industry support. The subsidies in place aren't really going to make a big dent in the market. And at the end of the day, the country as a whole is still pushing towards getting electrification to that village level. So I think that is going to be a country that's very important to oil and gas demand, that has big aspirational targets, but we're seeing very low penetration and a high risk of them missing these big aspirational goals as we move out. which continues to be pretty supportive for crude oil over the medium term.
So Matt, are you kind of saying as the punchline, you'll kind of take the under on how we perceive electric cars when you look at all those markets, or am I putting words in your mouth?
I think it's really going to depend on a country by country perspective. China seems to have pushed through policy and hit its targets, but you're seeing other countries like India fall well short of planned expectations. And those, in terms of the contrast of the vehicle market, are pretty similar in size and scale. So I think it's just going to be very bifurcated globally. I think the real punchline is we're not going to see a material impact on gasoline demand, which is about 25% of global crude demand in the near term. These are policies being put in place that will really start to matter as we accelerate new vehicle sales from 2025 through 2030.
Colin, you were going to take us on a tour in the pregame. I think it's like around the world in 80 seconds, but you're going to take us on a journey.
I'm going to take you on a journey across 7 charts. And the first one is actually UK natural gas. In the prompt contract, October 2020, is actually doing the opposite of what we're seeing in the United States. On Friday, the prompt October contract settled above 30 pence per therm. That level is important because that threshold has not been surpassed 98% of the time since January. And today's settlement at 31.19 just shows that the momentum continues to the upside. If you look there at the trough on July 20th, it's been almost an 80% advance in 45 trading days. One reason why we're seeing this is we had the kind of warm weather we're seeing around the world descend upon the continent and also upon the United Kingdom itself. And so there was a surprise weather event. Demand was higher than the local power authority expected. That led to a green out, much like we've seen in California. There was a large spike in power prices. We got the advance in the October gas price, as mentioned. And what you're looking at here is the water level in the Rhine River. And this is a statistic that commodity analysts pay close attention to because of the Rhine's importance for transiting cargoes, including chemicals and heating fuels ahead of winter. And when you see that the very dry conditions in Germany have given us the Rhine River level at overwinter of just 0.63 meters, what this means is there's going to be greater difficulty in getting heating fuels to places where they want to go. And hence, that's why you're seeing some of that bid for natural gas. And you can see there, not only is this one of the lowest levels in the past 10 years, it's one of the lowest even on a seasonal basis. Now, if there's going to be a bid on the margin for natural gas in Europe, it's interesting to keep an eye on China and what's happening there. And very quietly, we're seeing China's actual capacity for liquefaction is creeping higher. I think we all tend to think of China as an importer of natural gas. And so we tend to look at the regasification numbers. But the current statistic is that China could actually send out 4.68 billion cubic feet per day. That's 10% higher than a year ago, 27% higher than 2 years ago. When we look at cash prices for transportation liquid fuels in Singapore, this is a bit of an interesting result. The way to read the scatter diagram is if you're above the diagonal line, cash prices for jet fuel in Singapore are at a premium to bunker fuel, marine bunker fuels. If you're below the diagonal line, it's the opposite. You can see here on September 22nd, the premium is toward the bunker fuel. And so one of the practical consequences of the entire world shutting down its economy and seeing this very weak condition for passenger traffic on airlines is that jet fuel is becoming increasingly attractive on a price basis for blending purposes with higher sulfur fuels in order to meet the marine fuel specifications that have come into effect in the past year or so. And so we're keeping a close eye on the US TSA data. We have not yet recovered to above 1 million persons per day. When we look at the load factors across the US domestic fleet, we're still around the 55 to 58% level. And so for the time being, we're very likely to see that the heavier fuel is actually more valuable than the middle distillate. When we look at the futures volume on the Dalian Commodity Exchange, we get this chart. We've seen a huge increase in volume during the COVID period. Basically, from this past 6 months versus the prior 6 months, adjusting for the number of days per month, we've seen an increase of 40% across that commodity exchange. One interesting aspect of this is when we see the warm weather, the hot weather, and the droughts across the planet, agricultural prices are in motion. And again, we don't really get the sense people are paying close attention to this on the margin unless they are in these markets. But take a look at what's been happening with soybeans. On Friday, September 11th, the prompt price on CBOT closed above $10 per bushel for the first time since June 5th, 2018. You can see that the trough in that price predated by 1 month the trough in the Dalian cash yellow soybean price number 2. Those are direct comparables. And when we look at where we've been and where we're going, it's very likely that we're going to see some bid from China to the United States and to Brazil for soybeans, which is interesting because, of course, that's part of phase 1 of the U.S.-China trade deal. And then finally, with all of that in motion, it begs the question, are we seeing shipping activity pick up? And the answer is yes, we are. In fact, on Thursday, September 17th, this weekly statistic we get for World Composite Container Freight Index, it's a price index, made a new high. As you can see, it's increased by 80% since April 30th of this year. But be careful, because the motion is not evenly distributed across the planet. So just as a heuristic here, we're showing Los Angeles to Shanghai and Shanghai to Los Angeles. It's abundantly clear which way this traffic is flowing. It's very much coming from China into the United States, which, you know, we would guess most people would not anticipate, especially given all of the chatter about the trade war. So those are the 7 items that we're keeping an eye on the margin. It's a bit of a different flavor than what you get from the United States, but obviously very important.
I think we're only missing one thing, and that's U-Hauls from Portland to San Antonio, but maybe next week. All right, that was a great lead-in, guys. A lot of great data, a lot of interesting snapshots around the world. The Rhine River water level, do people really look at that, Colin?
Believe it or not, yeah. It's literally like, you know, one of the bread and butter things that you have to pay attention to if you're doing European power and gas.
Fantastic. All right. Well, we're trying to learn something every week. Let's get to the stars of today's show. Again, we're really super happy to have Mike Bingston, Michael Tarosian, Scott Gale, and our own Deanna Zhang. Today we're talking tech, and importantly, we're talking about the venture capital world, how corporates are adjusting to all these changes, what money is out there, all kinds of things. Let me start with Mike Bingston. Mike, it's so great to have you. You are, as I mentioned, you're head of the corporate practice there at Baker Botts, which I think is another way of saying El Jefe. What would you tell us about Baker Botts, what you guys are seeing, what you're busy with, how you're coping? You're great friends, and we just appreciate you coming on the show.
Well, Maynard, thanks for having us. This is a really great series that you put on. It's as evidenced by the prior commentary. It's got lots of great thought leadership, so we'll try not to drag that down, and hopefully we can add something to what's a great program for you guys. As your viewers probably know, you're used to seeing Baker Botts and Halliburton out in the oil patch, and you have been for a long time. So maybe the question is, what are we doing here talking about energy tech? As a bit of background, in the early 90s, as a firm, we decided that technology was going to be an important industry going forward, and we wanted to diversify into that in addition to our energy platform, and we did so. I think we were right about that. It's got to the point that our revenues from energy and technology last year were even in the firm. I'm not sure we saw, though, that energy and technology would converge in the way they are today. I'd probably be lying to you if we said, yeah, in 2020, the lines are going to cross and our lawyers that practice in the energy space are going to be collaborating with our lawyers that practice in the technology space. But that really has happened.
And Mike, I hate to jump in, but I just want to make sure everybody heard that. You said the size of your technology practice is the size of your energy practice, which is stunning.
That's right. Listeners in Houston probably find that, and even some of my Houston partners find that a bit of a fact that's hard to get their arms around. But it is true.
Show me the data. Show me the data. But
yeah, it's true. 13 of our top 20 clients were technology clients last year.
Wow.
Yeah, I think you still see us around, particularly in Houston in the oil patch too. But I'm proud to have Michael Trojan with me today because Michael really lives and breathes this every day. He practices. He's co-head of our emerging companies venture capital practice, what we call ECVC. He practices out of both our San Francisco and Palo Alto office, but he's also deeply involved with some of the accelerator initiatives that we are doing in both Austin and Houston. So he gets the energy sector. Part of what he does is energy tech, and I'm going to flip it over to Michael to kind of tell me what the view from the Bay Area is on the state of the energy tech in ECVC world.
great. Welcome, Michael. You're joining us from San Francisco, right, Michael?
Correct.
So you speak with authority. I mean, you're there. So we're ready.
That's great. Well, again, Maynard, thanks for having us, and Mike, thanks for the introduction. So what I thought I would do is just briefly talk about the general venture capital and corporate venture market from a broad general perspective, and what we've seen over, in the first half in the last quarter. And what we've seen is, broadly speaking, we saw, the numbers and numbers of deals and dollar values of deals declining in Q2, which is not surprising. But I think we were somewhat surprised that it was not as bad as it had been expected. And we even have seen a recovering trend towards the back half of Q2 when we're pretty bullish on Q3, at least in terms of the broad market. And so, what we saw is, in that early Q2 timeframe, you saw a lot of uncertainty over the, COVID-19 and the impact on the economy, and that was really at its height. And we saw companies that were focused on sustaining operations, reducing burn rate through headcount reductions and cost cutting and curtailing expansion plans and getting extension or follow-on funding from existing investors, and then accessing government funding under the CARES Act and programs like the Paycheck Protection Program that were there to help stabilize companies through this pandemic. And so, from the venture capital perspective and corporate venture perspective, at least what we've seen is that in Q2, we saw a lot of exercising of caution and triaging by investors and focusing primarily on funding and stabilizing their own portfolio companies. Coming out of Q2 and even, at the tail end of Q2, we saw investing start to recover in May, and I think we've seen that trend continue in Q3. And we've also noted, and I think others have as well, of course, that the effects of this pandemic have been different across different markets. We've already talked about some of that on the energy side. And while we've seen some sectors very heavily affected by the pandemic and resulting effects in the economy, it's not the same across all verticals. And so we're seeing some that have fared relatively well, and some have even found growth opportunities. And we're seeing this, across sectors, and I think we're going to talk more about that, how it's affected energy and energy tech and kind of going forward. I think significantly, even in the venture capital market, very significantly, there's dry powder in venture capital, $120 billion of funds that are available really to allocate, and years of runway until new funds are going to need to be formed. And I think even more critically for our discussion today, non-traditional investors, including corporate venture, we refer to as CVC, are still in this market, and they have significant influence, and that influence is growing. And so we're seeing participation in deals by corporates increasing. And in the first half of this year, half of the deal values had CVC in it. And we had this year the highest level of CVC new entrants that we've ever had. And so previously, those of us who lived through the tech world, the dot-com bust, we saw corporates coming in late and being the first to leave. We saw in the global financial crisis, we saw CVC having significant declines. We have not seen that to date with CVC, and I think that's really significant. The declines that we do see in corporate venture they track the broader VC trends, which a lot of us look at optimistically, and they don't signal a pullback. And I think very critically, the non-traditional, what we call non-traditional capital, which includes CVC, the dry powder for that group is huge. It's $240 to $340 billion. And I think, in this, for our discussion today, corporates and corporate venture is especially important to energy tech and the various sectors within energy tech, because we think at least, strategics are a really great fit for energy tech companies, whereas traditional VC, had kind of gone through it with the clean tech bubble, if you will, have maybe learned some lessons that they're maybe not the best fit or have the greatest impact for certain energy tech verticals. But strategics are really well positioned and a really great fit for energy tech, and they're in a really good position to lead and really help develop further the industry, I think, of the future. And we can talk more about that.
No, there's a lot in there. So just one big picture question that we don't have a feel for out here in energy land, which is just venture capital as an asset class. Is it growing? More money flowing into it? Is it the same? I know you said the CVC guys are coming, but it's just venture capital is just more money flowing in, period. Is that true or false?
It's true. And even in pre-COVID, it was, I would say, on fire. I mean, there was really, it would have to have been a kind of existential pandemic to have slowed things down, which we have seen. But what we are amazed at is that it's all, if there's a whole cycle to it, right? The VC funds have been able to raise new funds at big dollars, and there's a ton of capital that's waiting to be allocated. So that's continuing to grow. They need to find investments, and they're finding opportunities, and they're finding investments to make. And so from them, at least, that we're hearing from a kind of a marketing spin, if you will, they're still all in, and they think they are taking a longer term, and that's relative, it's relatively speaking, but they're looking at longer term, and they're seeing huge opportunities. So more funds being raised, more capital continuing to be available to be allocated over a longer period of time, and VCs are seeing exits. We have seen exits slow. But I think the consensus is that this pandemic and its effects will still have a limited duration. That's what's kind of built into this market now. If that changes, things will change. But seeing the exits as being robust and this being a limited duration, there's a whole lot of optimism and seeing of opportunity in this space. So I think we're going to continue to see strength. And just looking for the opportunities to explode again in terms of growth. And I think we'll see some effects of that within energy tech. I was giving them a little bit more of the macro level, but I think there will be continued opportunities as well in energy tech.
Okay, well, Scott, get ready because you're doing it. As you get ready, Deanna, what are the couple of comments you'd make about energy tech and how it either resembles general tech and where you see it as being different?
Yeah, I mean, if you the story's in the numbers, right? I think if you look at the chart that shows investment activity over time for venture capitalists and for growth equity, and you compare the Q2 and the Q3 numbers for 2020 with the Q2 and Q3 numbers for 2019 across all industries, I think, as Michael just mentioned, you'll see a pretty flat number. I mean, the change is like less than 1%. But if you do the same chart for energy, that drop is actually 16%, so much lower. And then if you hone in on that category even more and just filter out oil and gas deals, that number is 52%. So more than 50% of the capital invested in oil and gas venture type of deals has vanished because of COVID. And I think a lot of people ask, why is that? I think again, looking back at the numbers, you can kind of see sort of the reason why. I think if you look at the number of deals that have been done over time, I think the number of deals has dramatically decreased compared to the capital invested. So for all industries, the number of deals has dropped 40%, even though capital invested has stayed relatively flat. So that indicates to me that investors are doing fewer deals, but they're doing larger deals. And so that is, I think that's coming from two different areas. One is investors putting in more money into the companies they're already invested in. So companies that they, have a pretty high degree of confidence in. They're investors of those companies. So they're trying to capitalize those companies to be, well equipped for the rest of the year and for this period of uncertainty. And I think they're also on the new investment side, only investing in companies that they really, really like. And so I think when we're talking with investors about what they're thinking about these days versus before COVID, I think what you'll find is that whereas before they might have had 10 different focus areas, now that they're more looking at 4 or 5 different focus areas. So they've dramatically cut what they're looking at and focused in only on the areas they really, really care about. And I think, as energy transition becomes more and more of a big topic, as the industry starts to care more about carbon footprint and ESG scores, I think what you'll find is that oil and gas as a focus area is just it's less and less being it's less and less making the cut for being in that subset of focus areas for investors.
Okay, let's Scott, let's get you in here. And Scott, this is like Letterman, we saved you for last, but we really are excited to hear about Halliburton Labs. And if you saw in the picture, Deanna is actually on location at Halliburton Labs. So Deanna, get ready. We're gonna ask you to tell us on the ground what you see and how cool it is. But why don't we roll a quick video that we've got of Halliburton Labs and the concept, just to get everybody excited.
Demand for cleaner, affordable energy is existential. The future energy slate will be made up of a number of different sources, many that we have an appreciation for today. Halliburton Labs is an open, collaborative environment where early stage companies can be successful. It's intended to be a crossroads of the various participants that are important to the entrepreneurial ecosystem, including the innovators, the academia, the investment community, as well as the industrial setting that Halliburton Labs has to offer. Halliburton Labs brings access to Halliburton's facilities, Halliburton's people and extended business network, and Halliburton's technical and commercial capabilities and skill sets. Halliburton Labs is important to Halliburton because it demonstrates our commitment to the science and the technology and the innovation associated with our industry. So we're certainly looking for startups that are focused primarily on tangible tech, things that you can put your hands on, material science, hardware, chemistry, but also a pretty broad spectrum of applications, including energy generation, transmission, distribution, storage, as well as energy conservation. The application for participation in Halliburton Labs will go live September 25th for our first inaugural cohort that we'll bring on in January 2021. We encourage everybody that is working on clean energy problems to apply. Certainly, if you have questions, feel free to reach out. Follow us on Instagram, Twitter, LinkedIn for more information.
So Scott, we've been hearing so much about the world here as we've gone from Libya to Norwegian auto sales to the Rhine to Baker Botts, which now has a technology practice as big as its energy practice, to Michael and Deanna. You at Halliburton, you guys had some choices about how do we do what we want to do strategically, what's the most thoughtful way to do it. Talk to us about Halliburton Labs, what you guys are trying to do, and how you got to where you got to.
Maynard, certainly appreciate the opportunity. Thrilled to be here. Thrilled to have Deanna and Albert and the team. Great to be on the program. A couple of things, I think as we look back and assessing kind of innovation as a corporation and how we bring new technologies on board, certainly a number of different options that we could have taken. And I think what was clear as we looked out across the entrepreneurial ecosystem more broadly, there was clearly a gap in the support network particularly for tangible tech-based companies like hardware, material science, chemistry, and as kind of mentioned in the video, and appreciate the opportunity to debut that here on the show. It's something that those types of companies, particularly in startups, need more support, more patient capital. They need more access to mentorship, access to lab facilities. They need opportunities to demonstrate their products and their technologies. And so as we looked across that landscape, that was something that came to light as an opportunity for Halliburton to do something distinctly different in the space. We've got a lot of scar tissue as an organization taking hardware to scale. And so part of what we're doing here is bringing that capability to bear. For lack of a better term, we're putting an industrial wrapper around a startup for a period of time to really help them be successful in what they're trying to accomplish.
In our discussions of it, Halliburton, I think the number I've heard is there's 1,000 PhDs at the company. You're global. There's no severe weather or severe conditions or material question or manufacturing issue you haven't been around. But at the same time, it's not a corporate venture capital strategy. Talk to us about that aspect to it.
I think as we look across sort of the success of CVCs, and certainly that's an interesting way to kind of hedge your bets. One of the constraints around most CVCs that I've had interaction with and visibility to is they often sort of constrain themselves on the investments they're making, that it has to impact their run rate business today or have some line of sight to impacting their business. And I think that's important, and I think that's a key model. I think what's different about what we're doing with Halliburton Labs is we're deliberately looking for companies that are not involved with our run rate business. We're looking at things that are further afield, new technologies, and in part creating an environment where those particular companies can be successful. And so focused on that kind of founders first mentality. And so we do think that by not behaving like a CVC and behaving more like an incubator or an accelerator, that can create, again, a distinctive experience for the participants.
And I know you've got a company or two already in, and you've got an application process going. Maybe share a little bit about how all that works.
Really excited to have our first company that's on board. I kind of joke that they're our cohort zero. Nanotech Inc. has been with us for 45, 60 days. And it's really something that I think is important, particularly Halliburton Labs as a startup in and of ourselves. It's important to learn while doing. That fail fast mentality, I think, is really important. And so having a participant company on board allows us to really demonstrate and fine tune those capabilities in terms of bringing lab capabilities to bear to make assurances that we can do those things quickly. I think one of the concerns for a startup that's considering Halliburton Labs is how is a big established corporation going to be able to move quickly and meet my needs? And that's something that I'm really thrilled to share, that in the early days, we've been able to grind the gears of the organization in a time scale that I think is really impactful for the startup. So we're learning a lot as we go about doing that. And as you mentioned, we do have an application process that is going to start at the end of this month. So on our website, we'll have our application form will be available, and we'll be bringing on our first formal cohort end of January of next year. So we're excited about that, and we're making progress towards that end.
And how many companies do you think you'll have either in January or over time? Like, what's the capacity of how many companies can you host, or how have you thought about that?
Sure. Yeah, no, the game plan is to bring on 3 to 5 companies here in our first inaugural cohort at the start of next year. And we'll bring on 3 cohorts a year. So at maturity, kind of at any given time, we hope to be supporting somewhere between 12 and 15 companies.
And what's the so this is pretty innovative stuff here. You've put Halliburton Labs. It's located. It's within Halliburton. It's not like you guys are a separate location. So what's the reaction of the rest of Halliburton? Like, hey, you know, what are we doing? What's going on over there? You know, what's the mood?
The mood is generally one of excitement. I think obviously the oil field services sector in particular has been challenged in recent months and over the last several years, and with that comes sort of an expectation for change of some form or fashion. And so I think that's how we're being embraced, is that generally the sentiment, the phone calls that I have and kind of the internal evangelizing that I do around Halliburton Labs is met with a lot of optimism, and is then quickly followed by, how do I get involved? How do I help? And I'm excited to have a couple of folks who have full-time jobs that here at Halliburton, but they're kind of moonlighting with me here at Halliburton Labs. And so whenever they ask, I quickly put them to work.
Well, Deanna just sent me a message. She asked if she could stay at Halliburton. No, Deanna, you have to come back to TPH. But maybe, Scott, as we just circle back to the rest of the team, do you have, I know you have some connections to VC. You'll increasingly have connections to investors. You heard some of the comments around capital that's looking to invest in this unique space. Do you have any impressions, or what would you share about the strategy of knowing capital providers?
A couple of quick comments. I think that there's a clear recognition that the energy transition is underway, but that this is a long game, and that the future energy slate is going to be made up of a lot of different technologies and a lot of different fuel sources, and hydrocarbons is absolutely going to be a part of that mix. But that change is coming, and we don't know where that's going to land. And so for us, you know, we want to be able to help support a very diverse set of companies, and with that requires resources and opportunities to invest. And so I think from our perspective in bringing, I think, a reputation as Halliburton of being the execution company, a practical perspective to this kind of energy refresh that we're in the midst of right now. Lots of opportunities to connect on deal flow and other things, and it's something that we want to be collaborative. An open collaborative environment we think is really critical for startup communities to be successful. And kind of the last comment that I would make around it, that I think really summarizes it to some extent, is that startup communities really only thrive when companies that are in a position to take advantage of startups choose not to. And that's something that I think is unique to what we're doing at Halliburton Labs, and I think that that's something that those in the investment community should be excited about.
So one question, Michael and Deanna, I'm curious, capital formation within this space. Like Deanna had just made a comment before we went to Scott about oil and gas isn't drawing as much capital as a place to invest to make energy cleaner. Now, I think, Deanna, if I'm understanding that correctly, that's as an outside perspective. It's another way of saying oil and gas is the industry that tends to fund oil and gas getting cleaner, and oil and gas is obviously struggling right now. But are you guys seeing interesting strategies develop where, like, how are funds characterizing their mission? Are they saying we're the clean tech fund? Are you seeing renewables expand out into things that aren't technically renewables? There's alternative infrastructure. I hear that one a lot. Like, what are the banners that you hear funds being formed or investing under that might surprise our audience a little bit? Are you seeing anything new?
I think most of the funds try to keep their mandate as broad as possible and keep their options as open as possible, because frankly, I think there's still a lot of uncertainty around what it means to invest in energy transition. So if you call yourself the carbon capture fund, or you call yourself the renewables fund, I think that limits you unduly at this stage. And so I think what we're finding is that funds are trying to step back. And I think energy transition is a great term because it kind of leaves everything open. You can invest in fossil fuels related technology that falls into energy transition, and you can also invest in more traditional clean tech. But I think I've been hearing more and more actually that the term clean tech sort of it brings to mind a lot of ideas and notions from kind of the previous wave of clean tech technologies back in 2007, 2012 that just aren't true today. It's not just the renewables play; it's very much a wider umbrella. And so we've been seeing a lot more people try to just step back and use more general terms.
Yeah, and I can add to that. I mean, we certainly, and from the Silicon Valley perspective, we certainly saw venture, right, go through the clean tech, the bubble and the bust, and they had a lot of lessons learned there. Even though venture is in some ways a relatively small part of energy tech, and I think government and corporates are really more significant. It still had an impact on the industry at the time and on future investment, from VC. I remember back in 07, 08, we were doing some of the I was doing some of the largest VC-backed solar deals, and they were being run or funded by classic traditional VCs that were software and tech focused, right? And so there was this really kind of tech first perspective on clean tech, and those VCs put in lots of numbers thrown around, but put in 25 billion in clean tech, right, during that period of 06 to 11. And they lost half of that. Most of those companies went bust, and a lot of those investors stopped investing in those areas. So, clean tech got a kind of a dirty name in terms of the fact that those startups and investors lost a lot, and the LPs lost a lot of money, and it made fundraising difficult for in the future for those VCs looking to see other opportunities. And I think also, I think the traditional venture structure may not work for all energy tech, right? You have traditional software style or tech focused VCs, 10-year fund models, very a bunch of capital efficient bets, quick exits, not necessarily well suited to capital intensive energy or energy tech companies. But I think there are areas where for example, we can see strategics and corporates leading that. They've got a longer term view typically. They've got R&D, manufacturing resources, technical expertise, know-how, and business networks where they can really bring all of that to energy tech that we're seeing from Halliburton Labs, for example. And I think we're seeing there are funders of some of the basic research, and then we see incubators or accelerators, and also federal and state programs supporting these companies. But then I think we have the real opportunity for strategics and corporates to really lead in the overall resources to help with energy tech companies. And then I think there's still a place for a VC, but I think they're going to have to be thoughtful and maybe make some changes based on the lessons learned from the clean tech era.
I know Colin's got a question, but Mike Bingston, can I just ask you, it seems like what's different between the last time clean tech, the last time we might have tried all this, is that this time we realized we got to have the energy community fully partnered in this, and that creates an opening for Houston to be a really important center of merging energy technology and venture capital thinking. You mentioned you didn't expect your tech guys and your energy team to be growing together. What are you seeing at the firm? Are you seeing more and more of the of doing things that are both energy and tech? And Houston, does it feel like a place we're going to be able to do that?
You're right, Maynard. It seems like when everybody talked about it 10 years ago, the industry wasn't necessarily a willing participant. They may have talked it, but I'm hearing a lot different from energy companies now. I think they see it. It's over. It's now come over the horizon, and they seem to be embracing it. And we have we've rethought our energy practice group, and if you look at our subsector focus, 3 of them, renewables, energy technology, and hydrogen, are really technology practices in large part.
So Mike, you have a hydrogen group? I'm totally jealous right now.
We do have a hydrogen group. You
Oh my
can
goodness.
check out our webpage. That we have a webpage on our website if you want to check it out.
I mean, Airbus announces the hydrogen plane. You've got a hydrogen group. Colin, we got to start a hydrogen group.
No problem. Deanna just started it on the campus of Halliburton Labs. We're done.
That is fantastic.
If you think about it, we had an LNG practice, which was all around producing LNG, transporting it, selling it to different markets. I mean, we look at hydrogen, it's going to be the very same thing, and that we can bring our skills that we developed in our LNG practice to this area that we believe will evolve over time. So I just think that clients recognize this time it's kind of here to stay, and they're going to be both energy companies and they're going to be technology companies at the same time. So that's where we've seen the convergence. It's great to see the barriers, if there were those, between our energy lawyers and our technology lawyers. They're working side by side now.
See, that was like the golden moment of the show, finding out you've got a hydrogen group. Colin, take it away.
Yeah, Scott, it strikes me as we have this conversation that our world of law and finance still likes to categorize everything. In fact, when we have VC, we have Series A, B, C. I mean, if it can be categorized, we will categorize it. And one thing that most impressed me as TPH and Halliburton were talking about the vision for Halliburton Labs was how your management, all of you, were so focused on studying innovation in the 20th century, and how that happenstance, if you just put really smart people together and you do not have categories and you do not have walls and you let them just do what they do, you start getting, a Steve Jobs who likes fonts because he took a calligraphy class, and now all of us have been affected for the rest of time. You look at Bell Labs in the 20th century, and I know you guys studied Bell Labs as you saw this opportunity, how many people would have anticipated in advance that the utility company, the telephony company, would invent the transistor, the laser, cell phones, the communication satellite, and yes, the solar cell. And there are quotes from the early 20th century with the leaders of Bell Labs talking about the 21st century version of their own company would have to be energy focused. So it's a long preamble, but I think you guys have done such a good job in having enough structure that it's not happenstance, but bringing them in and letting them be themselves. Or you could just talk a little bit about your philosophy as you manage the labs.
That's an important point, Colin, and I love that you brought it up. In fact, it's something that as we have these conversations internally, a really important ingredient for innovation and by proxy the startup community is rebellion. And that is something that runs very countercurrent to established corporations. And so bringing that rebellious attitude and mentality is really important for disrupting from the inside out and being sort of open to those changes. And so it is something that we look at our own kind of story and our own version of this narrative, and not trying to fit ourselves into one particular tranche or definition or whatever it might be. We really do think we're bringing sort of a hybrid approach, but solving from sort of base principles of innovation and what drives that is absolutely critical and fundamental.
Well, to have the focus on engineers, I always laugh when people talk about how, the hydrocarbon industry isn't science oriented. Seriously? Chemical engineers, mechanical engineers, electrical, everybody's an engineer. And so I hadn't really focused recently on that whole point of the hardware versus software, but that strikes me as so critical, because if there is to be a breakthrough in nanotechnology and material scientists, it's probably not going to be a software engineer. It's going to be a chemical engineer, a mechanical engineer.
Completely agree. And I would say, in addition to rebellion, the creative class and engineers absolutely fall into that category. And that is, I think, something that is really going to make the Houston community really special is we are already seated with that creative class. And I think that there really is a really interesting inflection point that we'll see here in the coming years.
Just one last point, Maynard. It strikes me that when Bardeen and Shockley and Brattain came up with the transistor, they were in New Jersey. Silicon Valley didn't exist. Then Silicon Valley came into existence. I wonder if in the year 2060, we're going to look down and see Houston as the center of innovation in the United States. And it'll just be obvious to everybody in the year 2060. And we'll still have Silicon Valley and San Francisco, but this innovation hub in one of the great cities of the world.
Well, I think everybody on this call is all in. One question for you, Scott, as we wrap up, and then Deanna, you've got to describe what it's like out there for us. But I was struck listening to Mike. His organization, they've made changes. They've built a technology practice. We see time and time again in technology, particularly when you're changing the organization, you've got to have leadership buy-in. And I just wondered if you might comment a little bit about how your leadership team there at Halliburton views HAL Labs and how it fits into where the entire organization is headed.
And at the end of the day, it starts at the top. And our CEO has been heavily involved from the beginning. It is rooted in his passion and his vision in terms of how we see this unfolding. And so I think that's critical. It really has to be existential for the organization to persist. Otherwise, as I like to joke, the corporate antibodies come out in earnest. And big established companies have really well-developed defense mechanisms in place to keep the status quo. And so you just have to be comfortable sort of swimming upstream at the end of the day. So it's hearts and minds, it really is, and that takes a lot of time and effort, but it's something that is important work in sort of plowing that field and sort of establishing that foundation. And so at the end of the day, without Jeff's support, there's no way we'd be where we're at this point.
Mike, anything you would tell a leader out there who's trying to change his organization, to take it in a new direction, to take it into unfamiliar territory? Any lesson you draw from looking back on the Baker Botts experience?
I would just say you get to be prepared to get out of your comfort zone a little bit. It's all easy for us to wake up and do the same thing day after day, but you need to look down the, like I say, shoot ahead of the duck a little bit and get out of your comfort zone and embrace the change around you. So.
That's awesome. Well, Deanna, I did want to close with you. My phone is lighting up because when Scott said rebellion, I know we're looking for a theme for this year's Disruption Conference. That might be it. I don't want to lead the witness, but give us some impressions of Halliburton Labs and maybe tell us a little bit as we wrap up about disruption this year.
Looking around, I think it's a lab, and there's lots of shiny lab equipment around. Not any really that I can name.
Do you feel more creative just being there?
This is kind of the perfect playground for some of those creative minds and engineers that Scott talked about. I think these are really nice facilities, quite frankly. Like, I think any startup, coming into this that needs some sort of needs to test a process or needs a space with the equipment around them to be able to and have all these resources available to develop their technology. I think this really is a perfect space for that. I think oftentimes, when we talk about accelerators or incubators and different types of facilities that encourage startup innovation, oftentimes we talk about, these, open space concepts or office spaces that have their cubicle walls at 2 inches, or at a certain height to enable innovation. I think in the end, you really just need the hard equipment sometimes. And I think that's what Halliburton Labs can offer here. And on this disruption?
Yeah, tell us when the date is. Tell the viewers to get excited.
Yeah, so disruption will be the first week of December this year. And I think much like how I'm here in person, we will be going around and being in person for all of the viewers because it will be completely virtual at different companies and different facilities around the U.S. So that's the general concept.
Okay.
Excited
Well,
the market.
I kind of put you on the spot there, but we know you're hiding some things from us as you start marketing the conference. But let me just wrap up by thanking Michael and Mike at Baker Botts, Scott Gale at Halliburton Labs, and the crew, Mike and Matt and Colin, and certainly you, Deanna and Albert, for making the trip out to Halliburton Labs. It's fantastic. From my seat, watching all of this, you get to see Houston changing, energy changing, the world changing, and it's just a lot of good news, and it's a lot of fun stuff. And Mike, we want to come over and have lunch with the hydrogen group, and we got to do it right away.
All right, we will set that up for you. Thanks for having us.
Thank you, guys. Thanks, everybody.